Hi, everyone. This is Matt DiLorenzo, Chief Investment Officer at United Asset Strategies. Given all the news about rising interest rates and inflation, we thought it would be timely to give you a fixed income update. This way, you can come away with a better understanding of how we're seeing the bond market and how we're navigating through this environment. So, the first chart here shows year over year change in the consumer price index. And the first most obvious thing is that it's very high. So we had the year over year rate moving higher throughout 2021 and then continuing as we moved into 2022. A number of factors have contributed to this. We had initially a lot of pent up demand. We've had continued issues with the supply chain. We had a big fiscal stimulus. And more recently, we've had we've seen energy prices increase significantly in response to the war in Ukraine. But for me, the most important thing I think about is how is the Fed responding to this? What is the Fed doing with interest rates? Because that has a very direct impact on the bond market. If you look back at last year, we saw that inflation was rising, but the Fed was still at a very easy monetary policy stance. And that's really changed as we moved into this year. So this chart here shows the market's expectation of where Fed funds rate will be by the end of the year. And what you can see over here in January, the market expected that the Fed would hike 2 to 3 times this year. And that's moved all the way up to the market projecting 10 interest rate hikes this year. A lot of this in this area over here, it accelerated due to the energy price impact that I mentioned earlier. So given that the bond market is forward looking, bonds don't sit around and wait for the Fed to hike interest rates. They're forward looking and prices have corrected ahead of this, being that it's likely to happen and the Fed is projecting it. So what we've seen is significant price drops in many fixed income securities. And as we're managing for clients, what we've been doing is initially spending cash that we had reserved aside on bonds that we find interesting. And in addition, we've been selling shorter term and floating rate securities, which have held their value very well, to invest into some of the bond market segments that have gotten hit harder. So some of the areas that we like are long-term municipals. They've gotten to a point where yields are at levels we haven't seen in a very long time, as well as preferred stocks, taxable munis, and also callable agency bonds are a way to provide income on a very high quality security that we haven't seen in a very long time. So the first reason we've been looking at these securities and extending duration a little bit in the bond portfolio is simply that we now have the opportunity to generate more yield for our clients. So we've been making those shifts to achieve that. And the other reason is that there's actually a good chance that rates don't move higher from here and actually make a move back down. So we wanted our clients to have the opportunity to benefit from appreciating bond prices in the event that rates come down, which we see as possible. One of the things I'm looking at to make this determination is the yield curve. And we've recently had an inverted yield curve, which in the past has been a very good indicator of bond market bottoms and interest rate tops. So this chart here on the bottom left shows the difference between the 10-year treasury yield and the 2-year treasury yield. So when it gets to a negative point, this is when the yield curve's inverted and the 2-year treasury yields more than the 10-year treasury. So this has a lot to do with Fed policy and the market's expectation of how far the Fed will be able to go without slowing the economy. But as you can see, the big takeaway for me is in recent history, as the yield curve got inverted, it coincided with bottoms in the bond markets or tops in yields. So right here around the tech bubble, yields peaked, and being in a long duration fixed income was advantageous as yields came down. It happened again around the financial crisis. This was a good time to be in long-term bonds as yields came down. Again, at the end of 2018, the yield curve got very flat as the Fed was tightening policy. And after that, yields came down again. So Most recently, we had an inversion here, and the 2-year Treasury was yielding more than the 10. And so far, it seems to be stabilizing the bond market. It's appearing that it's very possible that this is happening again, and this could be a high in yields. So we never want to put all our eggs in one basket, but we this does give us some confidence to extend duration, which really provides clients with the opportunity for appreciation potential in their bonds should this be a high in rates and should this be a bottom in the bond market. So obviously there's a lot of nuances to what we're buying and how we're navigating, but I hope this gives you a solid overview and maybe generate some questions. And we'd love to talk about it if you have more questions. So feel free to reach out. And thank you, and have a nice weekend.